Good day, everyone. We have already discussed the first stage in the accounting cycle, which is the recording of external transactions. In this video, we are going to learn how to record internal transactions. Analyzing transactions not from the source documents, but from the unadjusted trial balance. Each account in the unadjusted trial balance has to be scrutinized to determine if there are internal transactions that need to be recorded to update the balance shown in the unadjusted trial balance. Wala na kasing source document tayong panghahawakan during the second stage of recording internal transaction. So it will be the unadjusted trial balance, which will be the basis of our analysis. In accounting, business transaction, also known as financial transaction, is an event that must be measurable in terms of money, and it is essentially impacting the financial position of the business. The financial position of the business is expressed in the basic accounting equation, asset is equal to liabilities plus capital, where capital is equal to beginning capital plus revenue minus expenses minus drawing. For example, in a merchandising business, when goods are sold to a customer for 500 pesos cash, it is an event that can be measured in terms of money, and it impacts the financial position of the business. The asset cash or accounts receivable increased by 500, asset merchandise is decreased, and the revenue is increased. So this event or occurrence is considered as a business or financial transaction. Similarly, when payment of 400 is made to an employee as his wage or salary, this event is also a transaction because it has a monetary value of 400 and it has a financial impact on the financial position of the business. It decreased the cash, increased the expenses, and decreased the capital. Only events that can be measured in terms of money are included in accounting records of the business. Meaning to say, these are the only events or transactions which should be journalized. Whether that event is supported by a source document or not, this should be recorded in the journals, then posted to the ledger. Other events related to a business to which no peso value can be reliably assigned and do not affect the financial position of the business cannot be called business or financial transactions that would require journal entry. Each business or financial transaction is recorded by making a journal entry. Since each financial or business transaction impacts financial position of the business, it must be made sure that it has been authorized by a responsible person and is properly supported by one or more source documents if transacted with a party outside the business before recording it in the journal. A source document is a document that provides basic information needed to record a transaction involving an outside party. Usual examples of source documents include sales invoices, purchase invoices, cash receipts, payment vouchers, statement of accounts, bills of exchange, promissory notes, and other documents containing the basic transaction details which can be presented as a proof of valid transaction. So these source documents pertain to those external transactions which have to be journalized. Now, if there are no source document, but it impacts financial position and capable of being measured in terms of money, then that should also be recorded as an internal transaction. So these are the characteristics of a business transaction. It is a monetary event. It affects financial position of the business. It belongs to business, not to the owner or any other person managing the business. It is initiated by an authorized person, and it is supported by a source document, document if it is an external transaction. In accounting, the transactions may be classified as external transactions and internal transactions. External transactions, also now known as exchange transactions, are transactions in which a business exchanges value with external parties or a third party. Since the business deals with external parties, there should be an evidence of transaction, which is called the source document. Therefore, external transactions are those which are covered or supported by a source document. All transactions other than internal transactions are external transactions. These are the usual transactions. External transactions are the usual transactions that a business performs on a daily basis. Examples of external transactions include purchase of goods or from suppliers. There is a purchase invoice supporting this transaction. Sale of goods to customers. There is a sales invoice supporting this transaction. Purchase of fixed assets for business use. Payment of rent to owner. Payment of gas, electricity, or water bills. Payment of salary to employees and others. A large portion of transactions performed by any business consist of external transactions. Internal transactions, on the other hand, are those transactions which do not involve outside person or external person or business entity. It does not relate with any other party. Internal transactions, also known as non-exchange transactions, do not involve the exchange of values between two parties, but the event constituting the transaction is measurable in monetary terms and impacts the financial position of the business. Examples of such transactions include recording of depreciation of fixed assets, inventory of supplies or recording of supplies used, determining the expired prepayments, establishing bad debts on accounts, and other similar transactions. Considering that internal transactions have no source documents, what will be the basis of our analysis? The basis of our analysis will be the unadjusted trial balance, which is the summary list of all external transactions. We will look into the trial balance, the unadjusted trial balance, and determine therefrom each item which might no longer be true because of some internal activity in the business. We'll look one by one on the items listed in the unadjusted trial balance to update them into their actual values. So, analyze the unadjusted trial balance to determine which account balances have to be updated for internal or unrecorded transactions. What is not seen and documented will now be recorded. Journalizing adjusting entries is recording the internal transactions of the business. All events and occurrences that modify the accounting equation, asset is equal to liabilities plus capital, which are not substantiated by a source document will now be entered in the journal. So here is the illustration of the unadjusted trial balance. So the first item is cash. So we will look into the cash balance. How much is the cash balance? Is this the correct cash balance? How are we going to determine whether this balance is the correct balance of the cash? So how are we going to establish the correctness of the cash, the amount of cash in this account? So cash includes bills, coins, bank balances, money orders, and checks. Cash is used to acquire goods and services or to eliminate obligations. Items that do not fall within the definition of cash are post-dated checks and notes receivable. There is typically no need to create an adjusting entry for the cash account. All cash transactions are covered with source documents, so there is really no internal transaction involving cash, except cash shortage or overage during a cash count. The inflow and outflow of cash are separate from revenues and expenses, so prepayments and accruals do not affect the cash account. Cash is analyzed for unrecorded cash transactions, for petty cash fund and cash in bank, because there may be cash transactions with source document but remained unrecorded and which have to be recorded at the end of the period. So, if the entries to the cash book are accurate, the cash balance found in the ledger would be equal to the amount of cash actually held by the business at any point in time. In order to ensure that the accounting records reflect the true cash situation, there should be a regular check that the amount of cash in the business cash box or safe is actually the same as the amount shown in the cash book. Cash count shall be conducted to achieve this aim. Any shortage or overage revealed in the cash count will necessitate an adjusting or updating journal entry. Maintaining daily cash sheet. So, a cash sheet is a daily reconciliation of cash received and cash paid out. If most of the business's transactions are transacted in cash, such as in a retail store, a cash sheet should be prepared at the end of each day. It is a sound practice to deposit all cash receipts in the bank account daily. The business daily cash receipts should generally be the same amount as daily bank deposit. Any reasons for a difference should be recorded in the cash sheet, such as a small amount of cash paid for a miscellaneous expense. If the daily cash receipts and cash deposits do not match, these should be investigated and any discrepancies between the two amounts should be reconciled. Maintaining cash sheets provides an alert to any shortage or overage of cash for the day. Some businesses simply count the cash in the register at the end of the day without maintaining a cash sheet, leaving them clueless to any shortages or overages. A shortage could be the result of theft, or it could simply result from the failure to record a special transaction, such as an expense hurriedly paid in cash. These shortages cannot be determined without a cash sheet. All the transactions in cash are recorded in the books, so generally there will be no internal transactions to be recorded or no adjusting entries to be journalized. However, in case of shortages and overages of cash after cash count, adjusting entry should be made to record this. cash count is always undertaken at the end of the period or at the end of the day. It is like taking inventory of merchandise or supplies to determine if there were cash shortages or overages. Only if there were shortages or overages that an adjusting entry would be necessary. Other transactions on cash will be external transactions or those related to a third party but cannot be recorded until the end of the period because the source documents are still in the hands of the issuer, like bank service charges and interest on bank deposits, or the recording of the source document is withheld until the performance of a certain act, like replenishment of a petty cash fund. The source documents are already in the business, but the same are not recorded because the petty cash fund needs to be replenished first before journal entry or entries can be made. So, wala talagang pwedeng maging adjustment sa cash kasi lahat ng transactions sa cash ay covered by source document. So, lahat may source document, therefore all transactions involving cash is are external transactions. So, it belongs to the first stage. However, there should be an updating of the transactions. These are still external transactions because these are still covered by source documents. But hindi pa lang hawak ng business yung source document kasi nasa possession pa ng third party. Like the bank statement which reveal or bank debit and bank credit notes which are still in the possession of the banks until a bank reconciliation is prepared, tsaka pa lang nakikita yon. So, yung mga bank service charges, wala pang record yung business noon, kaya hindi nare-record. Pero, merong source document yun from the bank. Nag-i-issue ng OR ang bangko for the service charges or makikita yon sa statement, bank statement. So, delayed yung dating nung source document, kaya hindi pa lang nare-record. So, these are still external transactions. Hindi ito internal transactions. But this is considered as an adjusting entry kasi at the end of the period pa nalalaman eh. So, yung adjusting entry, usually, are internal transactions. But not all adjusting entries pertain to internal transactions. Kasi yung ibang adjusting entries are just to update transactions covered by, supported by a source document. So, ito kasi sa accounting, we only use one term for every, we only use the word adjusting entry for all entries other than the original entry, which is somewhat confusing. Kaya nahihirapan yung mga students na maunawaan ang adjusting entry. Ano ba talaga yung adjusting entry? So, we should classify adjusting entry as updating entry, and one is to really recording of internal transaction. Kasi yung adjusting entry can be updating of transactions which are covered by source documents or recording of internal transactions which do not have source document. So, kaya ang hirap unawain ng adjustments because hindi mo alam ano nga ba yung adjustments. So, kung alam na natin ano yung internal transaction and external transaction, adjustments may mean recording of internal transaction or updating of external transaction. So dun sa updating of external transaction, ang ina-update natin yung mga transactions na covered by source document pero hindi natin kaagad na record during the period until the end of the period. Kasi sa dulo lang ng period natin malalaman or magagamit yung mga source document. Yun na nga, yung sa sa reconciliation ng bank at books, nagpe-prepare ng reconciliation statement, doon lang nakikita yung ibang mga source document like yung bank statement tsaka yung mga debit memo, yung mga NSF checks. So these are all source documents that prove external transaction but are not available during the recording process, na nagiging available lang at the end of the period. Katulad din ng replenishment ng petty cash fund. Pag nagbabayad yung business ng payment out of petty cash fund, hindi kagad nire-record yung expense kasi maliliit lang yung expense. Pinagsasama-sama muna lahat yung mga expenses na yon hanggang ma-exhaust or maubos yung petty cash fund, tsaka palang i-record yung expense, nakasummarize na yon at para magkaroon ng replenishment. So at the end, during the time of replenishment lang, pwedeng ma-record yung expenses. Pero nandun na yung mga source documents kasi may mga vouchers yun eh. Mag-i-issue ng voucher yung custodian ng pera, kung saan napunta yung pera. So yung voucher na yon will be the source document. Pero hindi mo pa yun marirecord during the period kasi hindi mo pa nire-replenish eh. It is only after replenishment that the transactions will be recorded. So, ito yung sinasabing the petty cash at the end of the period, petty cash should be replenished to determine actual expenses incurred for the period, because it is only when the petty cash is being replenished that expenses paid out of petty cash fund will be recorded. So what is a petty cash fund? A petty cash fund is a small amount of cash kept on hand to pay for minor expenses such as office supplies or reimbursements. A petty cash custodian is responsible for this fund and maintains an up-to-date reconciliation of the amount of bills and coins remaining in the fund. The fund is, so here is the custodian. So first setup is the setting up of the petty cash fund. So the business draws check to set up the petty cash fund. So from cash in bank, magiging petty cash fund. Muna, pili tayo ng magandang color. So here is the cash to set up the petty cash fund and then taken from the bank kasi cash in bank at saka cash on hand lang. And usually all the cash on hand will be deposited in the bank. Therefore, to set up the petty cash fund, you have to withdraw from the bank. And you put that in a safe. After withdrawing from the bank, you put that in a safe or in a box or in the drawer of the petty cash fund custodian. The fund is typically replenished once a month, or if the amount has reached its lowest amount. Petty cash fund is also known as imprest system, where fund is used for making small payments that are impractical to pay by check. And examples of the items that may be paid for from the petty cash fund are flowers, food, office postage, gifts or presents, supplies, taxi charges, and expenses of similar nature. The establishment of a petty cash fund begins by drawing, ito na yung illustration na to, by drawing out a check to cash, cashing it from the bank, and placing it in a petty cash box. A petty cash custodian should be designated to safeguard and make payments from this fund. At the time the fund is established, the following journal entry is needed. So in setting up, you just do not withdraw from the bank, but you have to also record the transaction. So debit petty cash fund and credit cash. So anong source document nito? Yung cheque. Pag set up niya, yung cheque yung source document. Is this an internal or external transaction? It has a source document. You record the, or it cannot have a source document. What if the money is not in the bank, but in the possession of the, is the check a source document in this case? Not necessarily, no, because check represents cash eh. So there is no external person involved, but it impacted the financial position. Did it impact the financial position? Was there a change in the financial position in the setting up of petty cash fund? Wala rin kasi from cash to cash eh. Hindi na bago yung cash account. So actually, there is no transaction in setting up of petty cash fund. There is no transaction, but it has to be recorded. It has to be recorded as a journal entry. So what could that be? It could be a memorandum entry also. Will that be, what will be that? But it can be interpreted in terms of money. So it can be interpreted in terms of money, but will you consider the impacting, the setting up of a petty cash fund is an event that impacts the financial position, meaning it affects the financial position. So cash converted into a petty cash fund, was there any change in the financial position by that transaction? I guess it would be, it has an effect on the financial position considering that there was a change in asset. So there was a change in asset from being an ordinary cash into a petty cash. So we will consider the transaction as external because it has a, we will consider the transaction as internal because it has impact on the financial position and capable of being interpreted in terms of money. But it does not have a source document because a check is not a source document but a representation of money. So it will be a recording of internal transaction. Is check a source document? So a check itself is not a source document because it is money. Money is not a source document. It is an asset. There is no transaction there. It is an asset. It is a proof of asset. It's not a proof of transaction. A source document is a proof of transaction. So a check is not a proof of transaction. It is a proof of money. So setting up of a petty cash fund is an internal transaction. It does not involve a third party. It does not have source document, but it has impact on the financial position and it can be interpreted in terms of money. So this is the petty cash voucher used to support the disbursement from the petty cash fund. Policies should be established regarding appropriate expenditures that can be paid from petty cash. When a disbursement is made from the fund, a receipt should be placed in the petty cash fund. So this is the proof of expenses from petty cash fund. When a disbursement is made from the fund, a receipt should be placed in the petty cash box. The receipt should set forth the amount and the nature of expenditure. The receipts are known as petty cash vouchers. At any point in time, the receipts plus remaining cash should equal the balance of the petty cash fund. As expenditure occur, cash in the box will be depleted or will be decreased. Eventually, the fund will require replenishment. A check for cash is prepared in an amount to bring the fund back up to the original level. The check is cashed and the proceeds are placed in the petty cash box. At the same time, receipts are removed from the petty cash box and formally recorded as expenses. So that was what I was explaining a while ago, na kapag may petty cash fund, bigay lang ng pera at kuha lang ng resibo. So at the end of the day, i-record yung mga binayaran out of petty cash fund. Pero hindi mo pa rin i-record yun sa journal, yung mga expenses. It is only when the petty cash fund is being replenished that the expenses are recorded in the journal. So here we have an illustration. Dun sa example natin, nag-set up ng 1,000 petty cash fund. Tapos, dito, nagkaroon ng mga gastusin. Dun yung mga vouchers, eto. Merong 390 office supplies, gasoline, 155, coffee and drinks for clients, 70. Actual expenses, 615. This is the amount paid out of petty cash fund. Kaso nung binilang, ang perang natira, yung resibo 615 pero ang pera 365 na lang. So ang total niya is 980. Meaning to say merong 20 pesos na shortage. So cash short and over ang tawag doon, or cash shortage or cash overage. Occasional errors may cause the petty cash fund to be out of balance. The sum of the cash and receipts will differ from the correct petty cash balance. This might be the result of simple mistakes such as mathematical computation errors or errors in making change. Or perhaps someone failed to provide a receipt for an appropriate expenditure. Whatever the cause, the available cash must be brought back to the appropriate level. The journal entry to record full replenishment may require an additional debit for shortages or credit for overages to cash short or cash over account. So, dito nakita natin na mayroong cash shortage. Pero kailangan i-replenish natin itong petty cash fund natin up to the 1,000 pesos. So, hindi natin pwedeng i-replenish lang ng 980 kasi yun lang yung gastos at yun lang yung hindi natin pwedeng i-replenish ng 615 lang kasi yun lang yung nagastos talaga. Kailangan isasama natin itong 20 na to. Kailangan ang replenishment natin ay 615 plus 20, 635. So the journal entry to record full replenishment in case there is a cash shortage will be lahat ng expenses. So yung 390, yung 155, yung miscellaneous expense, tapos meron tayong bagong account, yung cash shortage or overage account. Kasi doon mo i-record lahat ng cash shortage or overage during the period. So you credit the account cash. This is to replenish petty cash receipts on hand totaled 615 related to office supplies, gasoline, coffee, and drinks, and then the shortage. Cash short, cash short or over account is an income statement type account. It is also applicable for situation other than petty cash. For example, a retailer will compare daily cash sales to the actual cash found in the cash register drawers. If a surplus or overage is discovered, the difference will be recorded in cash short or over account. A debit balance indicates a shortage, which is an expense, and a credit balance represents an overage. So take note of this account. So this is a new account for you to learn, cash shortage or over. Lahat ng kulang sa cash after cash count ay ilalagay natin dito sa account na ito. So increasing the base fund, meaning to say yung kunyari konti na lang yung petty cash fund, hindi na enough. As a company grows, it may find a necessity to increase the base size of its petty cash fund. The entry to increase the fund would be identical to the first entry illustrated which is the setting up of the petty cash fund. The amount added to the base amount of the fund would be debited to petty cash and credited to cash. Katulad lang din ng pag-set up ng petty cash fund. But this time, mag-i-increase na yung petty cash fund. Kunyari, yung 1,000 kanina, kulang na, hindi na kaya ng 1,000 ng petty cash fund sa dami ng mga petty expenses or small expenses, dadagdagan natin ng 4,000. So, para maging 5,000. So, debit 4,000 petty cash fund and credit cash. So, we're done with the cash on hand. So, yung petty cash fund, cash on hand yun eh. Yung cash sheet na daily cash sales, ano yun, cash on hand pa rin yun. Now, this time, it is determining the actual amount of the cash in bank. So, another tool used in determining correct cash is the bank reconciliation statement. A bank reconciliation statement is a statement that depositors prepare to find, explain, and understand any differences between the balance in the bank statement and the balance in their accounting records. All transactions between depositor and the bank are entered separately by both parties in their records. These records may disagree due to various reasons, thus show different balances. The purpose of preparing a bank reconciliation statement is to find and understand the reasons of this difference in account balances. So here is the illustration of the bank reconciliation. The illustration shows that the balance per bank in the beginning which is unreconciled with the business books of accounts. So what are the possible reasons for the difference between the balance per bank statement and depositors' books of accounts balance? Usually, the balance on the monthly bank statement does not agree with the depositor's accounting record. The usual reasons for this disagreement will be the following. So, ayan, yung outstanding or unpresented checks. O, outstanding checks, also known as unpresented checks and uncleared checks, are the checks that have been issued by the company to a creditor but have not yet been presented for payment. The amount of these checks are recorded by the company, but no entry is made by the bank before the end of the month. So, nag-issue ng cheque yung business, yung taong inisyuhan niya maraming pera, hindi kagad nagpunta sa bangko para i-encash yung cheque. So, at the end of the period or at the end of the month, hindi pa rin niya wini-withdraw yung pera from the check. That becomes an outstanding or unpresented check or uncleared check. Tatlo yung name niya, outstanding, unpresented, or uncleared. Ibig sabihin, na-issue na nung business, pero hindi pa nape-present nung tumanggap ng cheque doon sa bangko para ma-encash. So, sa business records, deducted na yon as cash in bank. Pero sa bangko, hindi pa nila ma-deduct sa account nung business kasi wala pa naman silang nakikitang cheque na pinipresent. So, the amount of this example to, let's take an example. The business issued a check to Mr. Tomas, one of its creditors, for 500 on 30th January 2020 and entered it immediately in its accounting records. Mr. Tomas did not present or deposit the check in his account before the end of January. The bank statement for the month of January would not show the entry for that 500 because Mr. Tomas did not present this check before the end of January. It would create a difference of 500 between the balance in the business accounting records and the balance in the bank statement. Now, the next item that will be the reason for the discrepancy or being unreconciled is the deposit in transit, this one. So, what is a deposit in transit? Deposit in transit means the cash received from a party has been recorded by the depositor but has not been entered by the bank in the bank statement. It usually occurs on the last day of the month. For example, the business received 800 from Mr. Yap, one of its debtors, on 31st of January 2020. And this was recorded immediately in the business books of accounts. This cash was sent to the bank to be deposited into business account, but it reached too late to be entered in the business bank statement for the month of January. It was recorded by the bank on the bank statement of the following month, which is February. The balance in the business books of accounts would be different from its bank statement. So this is deposit in transit. The banks have cut-offs for checks, for clearing of checks. So some banks have it on or before 11 a.m. that all accepted checks will be cleared the same day. But if it is accepted beyond 11 a.m., then that will be considered as transaction for the succeeding day. Therefore, it will never be part of the, if that happens at the end of the month, that will not be part of the bank statement for the current month, but of the succeeding month. Yun yung tinatawag na deposit in transit, na ilagay mo na sa bangko, pero hindi pa na-record ng bangko kasi inabot ng cut-off. Sa susunod na buwan na yon makikita sa... So, re-reviewin mo yung bank statement ng susunod na buwan para makita mo yon kung nandun nga. Or inquire mo sa bangko kung na-clear na kinabukasan ng end of the month yung cheque na inihulog. Okay. Another will be dishonored checks or no sufficient fund checks. Ano ba yung NSF checks na yan? When a customer deposits a check in his account, the bank immediately credits his account with the amount of the check. Sometimes such checks are not honored because the person issuing the checks does not have sufficient funds in his account. In such a situation, the bank reduces the balance of the customer. The dishonored check is returned to the depositor as NSF check. For example, the business received a check from Mr. Chavez for 5,000. This check is immediately entered in the accounting records as collection of account and deposited in the bank account. After depositing the check, the bank immediately credited the business account by 5,000. Afterwards, the bank announced that Mr. Chavez Bank did not honor the check issued by him because there were not sufficient funds in his account. Because the bank of Mr. Chavez dishonored his check, the business account will be reduced by its bank by 5,000. And the dishonored check of 5,000 will be returned as no sufficient fund check. The balance in the business accounting records will differ from the balance in its bank statement by reason of such NSF check. Nakuha niyo ba? So, kunyari, si Mr. Chavez, customer ni Terimacor. Nag-issue si Mr. Chavez ng dated check kay Terimacor. So, si Terimacor, i-record na niya yan as cash. Kasi check is as good as cash if it is dated. So, i-record na niya yan as dated. Kung natanggap niya yan ngayon, i-record na niya yan ngayon. So, sa books ng business, recorded as cash na yan. Kaso, naging NSF check. Hindi pa nare-record yun ng business as NSF check dahil hindi pa niya natatanggap at the end of the month na NSF pala yun. So, that will be a reconciling items. Inilagay na muna as an addition to cash, then you have to deduct that because that amount has been dishonored. So, ito yung balance per bank book, record to ng bank. So, itong outstanding check, hindi naka-record sa bangko. So, para mag-reconcile yun dun sa business records, i-add ng bangko. Now, itong deposit in transit, na-record na ng business as a deposit. Ito, ima-minus ito dun sa balance ng business. Kasi hindi naman yan na-recognize ng bank. Yung dishonored check, naka-record na yan as addition to cash, ima-minus din natin kasi hindi naman natin alam na na-dishonor pala. So, These are the outstanding unpresented checks. These are the reconciling items. So, meron pang dalawa, other credits directly into the bank and other items such as interest, income, and service charges. So, bank service charge, bank service fees and other charges, bank interest, income on deposits and savings. So merong dalawa, bank service fees and charges. Ito yung expense na ini-impose ng bank dun sa mga depositors. Ito naman, minsan yung bangko naman nagbibigay ng interest income para dun sa deposits ng mga clients nila. So, bank pays interest on some accounts. If this interest income is credited in the depositor's account without informing the depositor, the bank statement and the depositor's record will not agree. Service charges, banks sometimes provide various services to its depositors and deduct service charges from their accounts. The depositors usually are not aware of such deductions. These charges create also a difference of balance between bank statement and depositor's record. So these are the things that you should note as reconciling items. So outstanding or unpresented or uncleared checks, deposit in transits, dishonored checks or no sufficient funds checks, credits directly into the bank, and other items as interest, income, and service charges. So, itong credits directly into the bank, sometimes may mga ibang customer na diretso nagbabayad sa bangko, hindi na alam nung business. So, yon, pwede yon doon. Reconciling item yon. So, these are the steps in the preparation of bank reconciliation statement. Step 1, find the deposits in transit. The first step is to see if one or more deposits are in transit. This can be done by comparing the deposits in business books or records with the deposits shown in the bank statements. If the deposit in the business accounting records that has not been shown in the banks, if there are deposits in the business accounting records that have not been shown in the bank statement, it means that deposit is in transit. Add to the bank statement balance all deposits that are in the business accounting record but have not been entered in the bank statement. So deposit in transit should be added to the bank statement balance. Step number 2. Find outstanding or unpresented or uncleared checks and deduct from bank statement balance. Find all the checks that have been issued but have not been presented for payment. This can be done by comparing the checks issued in the business accounting record with the checks paid in the bank statement. If the accounting record shows that a check has been issued but the bank statement does not show a corresponding entry for that check, this means that it is an outstanding, uncleared, or unpresented check. Deduct from the bank statement balance all the checks that have been issued and entered in the business accounting record but have not been paid by the bank. So, outstanding check ang nag-issue nun ay yung business. In-issue na niya, pero hindi pa nare-record sa bangko. So from the bank balance, you should deduct those outstanding checks. Step 3, find and add credit memorandum to the business accounting record. Bank issues a credit memorandum when it collects a note receivable on behalf of the depositor. This was what I was telling a while ago, that sometimes the bank collects accounts for and in behalf of the depositor. So the bank issues a credit memorandum for this, meaning to say that the account of the depositor is being increased by the collection of note in favor of the depositor. Find if there were any credit memorandum or memoranda issued by the bank which were not recorded in the business books or accounting record. Add to business book. This time, it should be added to the business books because it has been recorded in the bank books but are not recorded in the business books. So to reconcile, what has been recorded in the bank should also be recorded in the books. So step number 4, find and deduct the amount found in the unrecorded debit memo from the business books of accounts. Bank provides various services to its depositors such as printing checks, processing NSF checks, and collecting notes receivable and similar items. Bank deducts charges from depositors' account for these services and informs the depositor about such deductions by issuing a debit memorandum. So find any debit memorandum not recorded in the business accounting record. Deduct from the business book balance any debit memorandum issued by the bank but not entered in the accounting record. So yung bangko, alam niya na yung dineduct niya dun sa client niya. Pero yung client niya, hindi alam yung dineduct ng bangko. So yung client, kung may business siya, i-deduct niya dun sa balance niya per books yung mga charges ng bangko na hindi niya na-record pa. Step number 5, after doing the first 4 steps, determine if the balances per books and bank statement are equal. See whether the adjusted balance of the business accounting record is equal to the adjusted balance of the bank statement. So, ina-adjust mo pareho. Ina-adjust mo yung bank statement balance at ina-adjust mo yung cash in bank balance dun sa books ng business. So, tingnan mo kung nagbalanse na siya. At kung nagbalanse na, yung mga ito yung step number 6, nagbalance. Nakita mo, nagbalance. Tama na yung reconciliation mo. Make appropriate journal entries. The final step in a bank reconciliation is to prepare appropriate journal entries for the items that have not yet been recorded in the accounting record. So these are not internal transactions. These are external transactions because these have source documents. Kaya lang delayed nakuha ng business yung mga source documents. So you have to make journal entries, not adjusting entries. So these are updating journal entries on cash. Ang tanging adjusting entry lang sa cash ay yung cash shortage or overage kasi internal yon, walang supporting document. In summary, generally, there are no internal cash transactions since all cash transactions are covered by a source document, except in case of cash shortage or cash overage. The cash shortage is recorded as a debit to cash shortage and a credit to cash, and a cash overage is recorded as a debit to cash and a credit to cash shortage or overage account. There are tools or means employed to reconcile actual cash balance with the books balance. Cash on hand, daily cash sheet ang ginagamit. Daily cash sheets are utilized to determine reconciliation of daily cash balance with actual cash count. And then cash in bank balance, a bank reconciliation statement is prepared to determine that all transactions involving checks and bank deposits are all taken up in the books of accounts. So this is the end of our lesson on recording external transactions. This is the end. This is not the proper slide for this. This summary ends the lesson on the recording of internal transactions on cash and updating of external transactions on cash. So the only internal transaction found in cash is the cash overage and shortage. The rest are external transactions because these are supported by source documents. So that ends our discussion for cash. The next topic will be on accounts receivable. How are we going to recognize the adjustments or the internal transactions on cash on accounts receivable?